CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
So good morning and welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. We are the leading index provider in the digital asset space. With me, as always, we have Mark Pilipczuk, research analyst at CF Benchmarks, Tomas Perfumo, our chief economist at Kraken, along with Cristian, Isac, the product manager at CF Benchmarks. We have not one, but two guests this week. David Lawant, who actually is, I would say, a regular on both the podcast side and on the X Spaces, who is head of research at Anchorage Digital, good friend of the show. And joining us for the very first time is Pascal Hügli. Did I say that? Did I pronounce your last name right, Pascal?
Yeah, it's about right. Yeah, it was German Hügli, but yeah, you're right.
Okay. You know, it reminds me. I'm a car guy, and there's this car show that's for Porsches. It's called Luftgekult, and you're supposed to say like Luftgekult or something like that. But it's a big show here in California. You are of course from Less Noise More Signal, the Substack blog. You also have your own podcast show. We have a lot to cover this hour. We're going to talk about the debasement trade. We're going to talk about how that's impacted everything from performance and asset classes to fund flows. We're going to talk about the Jackson Hole meeting that's starting today. And before we do, I do want to give you a chance to just introduce yourself, talk a little bit about your blog, the podcast, and your background.
Yeah, that's great. Yeah, thanks a lot, Gabriel, for the introduction. So yeah, as said, my name is Pascal. I'm originally from Switzerland, currently also living in Switzerland. And as you said, I have a blog, Less Noise, More Signal on Substack, where I regularly write about crypto, macro, stable coins, like all the sort of the conjunction of all these topics, given that I have great interest in them. I also do have a regular podcast where I interview like experts, like people who are more expert than me, I would argue, to just learn from them on all these topics as well. And so this is kind of like the thing I do on the side, to be honest. I also am part-time working at a Swiss bank, a traditional Swiss bank. It's called Maerki Baumann. We're almost 100 years old. And the bank ventured into crypto about like 6 years ago. So predominantly providing like bank accounts to corporate clients. And then it grew into providing bank accounts to private clients. And by now we bank over 500 companies from the digital asset space here over in Switzerland, being one of the very early pioneers and players in that space. And we're trying to grow that business, and we're just very happy to be part of that digital asset space, given that we have such a traditional leading and now also with crypto being forefront there. And so I'm joined there as investment manager a couple of years ago, as I said, part-time, which is very favorable and very nice. I'm very grateful for being able to have these two hats on. I have a third hat where I'm lecturing in Switzerland, also on the topic of digital assets. So it's my bread and butter, and I hope I can provide some context here as well.
Yeah, no, I'm excited for your context. I know you're an excellent podcast host. If you were hosting the show right now, I'm sure you'd do a much better job than myself, but I was a guest on your podcast. I really enjoyed it. You did an excellent job. So I think it's going to be fun to turn the tables now. You're now in the panelist seat. And we'll get your takes here today. So we have a lot to go over right now. There's a lot of things happening with the markets. It appears that the debasement trade is back. One article that I read in CNBC this week had this quote, which Wall Street has dubbed this debasement trade as a nod to historical practice of rulers such as King Henry VIII of England and the Roman Emperor Nero, who diluted or debased gold and silver coins with cheaper metals. So that's the kind of overarching theme when we talk about debasement is basically diluting purchasing power, diluting value. And in this case, we're talking about fiat currency. We're talking about the dollar, but we're not talking about just the dollar, right? We're talking about perhaps even a global phenomenon as these sovereigns grapple with mounting deficits and debt. So the U.S. debt is above 40 trillion. This has impacted the dollar. It's down 2.5% this month. And Pascal, I'll give you the first chance here. You've talked about the fiat era as at large, as a mistake that could, potentially have large ramifications. Would you give our audience your definition of the debasement trade, and kind of just tell us what you're looking at right now?
Yeah, thanks a lot. Yeah, no, sure, that's right. It's interesting that you reference Henry and the debasement trade. Henry VIII, I think you said it. That guy. And then Nero from the Roman Empire. I wrote a book, which I published also about 1.5 years ago. And there, which is quite interesting, and it leads up to the discussion, we reference Henry VIII, and he was actually going down in history as Sir Coppernose, and a lot of people don't know this. It's actually because, as you said rightly, he was debasing the currency, and he did so by kind of adding bronze or copper, I think, to the gold coins. And at first, you didn't recognize this because there was like some sort of layer on top of the copper. But then as time went by, that sort of thing got shiveled away, and that's all of a sudden like the copper became visible, and that's why he went down in history as Sir Coppernose. And I think thinking to this day now, we have the internet. I remember these people back then. They might have noticed it with that coin, but a lot of people might have not heard it, because there was a lot less information flowing around, and the information asymmetry was way higher than we have today. I mean, we have the internet, we have X, we do spaces like this where everybody can inform himself, and that's why I think it's also probably to the benefit of the people out there, because it's happened all throughout history, and it's happening still today, and so people better understand what's happening. And I think, as you rightly said, the debasement trade is already a mainstream concept by now, and is coming back. And why is it coming back just now? So my kind of interpretation is because we've seen these Treasury buyback announcements. We saw like Bessent intervening in Japan a couple of weeks back, and then you had him signal something about the TGA, the Treasury General account, where he wanted to maybe unleash some liquidity from there. And it's all about managing the longer end of the curve. And I think there's a lot of room left. We can maybe talk about this. There's many more tricks he has up his sleeve and that he can pull. And maybe we'll learn about some of them also at Jackson Hole. But that's exactly it, And so I think this was sort of the signal that the market also, when you look at BTC, kind of needed. We all knew that it will come back. It always comes like in waves, where this kind of fires up again, but they kind of have to get things under control. And I think we're now in another such period, at least for me, like conceptually, I think until the end of the year, liquidity will kind of turn up, which will be positive risk assets. And I especially want to look for more of these sort of announcements and hints coming out of the Trump administrations, because I think they also use them quite strategically to kind of make sure they can manage everything that's going on, And so we can maybe talk about this also in more detail, but that's definitely how I view the situation, and what I'm sort of looking for, especially these qualitative hints coming out of the administration. Because I think maybe my last point, I mean, the buybacks in size, they maybe have not mattered that much, and they might not matter at the, or maybe at the margin only, but it's really the signaling that's done here. Like, hey guys, this other maybe Mario Draghi moment, for the Europeans out there, whether he said whatever it takes. And I feel like it's a similar vibe here with Bessent, who's really like, we need to get this under control because of the AI trade of everything. So yeah, that's the interesting thing here.
I mean, and we're seeing this reflected in asset price performance. If you look at Bitcoin since the Treasury announcement, it's up 16.2%. You can compare that to another proxy for debasement gold. It's relatively unchanged. It's up like 1.5% since that announcement. So Bitcoin clearly becoming a favorite and the fastest horse in the race. David, I want to get your take on this. Look, we just outlined a bit on how the historical, I guess, parallels have run with debasement. If you look back, going back ages with Henry VIII and the Roman Emperor, clearly this is a theme that keeps reoccurring. Is it fair to call this a trade, or how would you call the monetary debasement? Is it a regime or more of a trade?
Great question. We actually talked a little bit about this, right, Gabe, a few days ago. There's an analyst in the space. Her name is Noelle. Probably a lot of folks know her here. She's one of the, I would say, leading thinkers as it pertains to macro and Bitcoin and crypto more generally. And I was in the meeting with her quite a while ago, maybe a year ago or so. And she was saying exactly this. She was saying the term debasement trade shrinks a little bit the importance of what is actually happening, right? Because when we think about a trade, it's usually something that we think will last maybe a few months, maybe a few quarters at the most, and then the market will move to something else. I think here we're seeing a very different process. I do think this is all a secular trend. Having that said, the trend will be more and less in vogue over time. Obviously, one of the issues, and I think actually one of the key reasons why Bitcoin and crypto more generally have underperformed the broader market, especially in the maybe Q2 of this year, is that a lot of the attention has shifted to other things, right? There's obviously the AI frenzy and all the related and adjacent themes, right? So there's AI, there's memory, there's compute, there's energy. There are other very sexy themes in the market today, things like robotics, maybe defense, and crypto was just not part of that. We've been there. We have been in and out of favor as it pertains to the overall market narrative. And this is not new for us. To me, it was pretty clear that the, let's call it, quote unquote, debasement trade narrative would come back at some point. What was probably more surprising to me was how fast it came back, at least if we measure it by how things are reflected in the Bitcoin price. I was visiting some of our clients and counterparties and prospects just 2 weeks ago. And I got to do like a bunch of meetings, like maybe almost 20 meetings in a span of 3 days. And every smart investor I was talking to was feeling that the macro winds were changing. So this is probably a week before we saw the big announcement from Bessent and that day when Bitcoin really ripped higher. So that was like a week before that. And I was talking to a bunch of our clients and market folks, and everybody was feeling this change of direction. The gold market by then was already sniffing things a little bit, right? So gold has been on a decent uptrend for now, maybe 4 to 6 weeks or so. And at the time, Bitcoin was still stuck at that 64K level. And everybody was like, I'm not sure what it's going to take to move Bitcoin or to take Bitcoin out of this range. And it turns out that I think has been alluded a little bit here. Bitcoin was oversold, right? Everybody who had to sell Bitcoin at that point, I think would mostly have sold. you were seeing an interesting phenomenon in which even news that you would expect to impact the price negatively were not anymore. So things like, I mean, there was the cold card hack, which you think you can argue there's not a broad market impact, but I mean, still, I would say negative for the Bitcoin complex as a whole. You had a few big players announcing Bitcoin sales. So you had a number of announcements, and the Bitcoin price was not moving. And at the same time, volumes and liquidity trends were extremely low. I remember that just the weekend before Bitcoin ripped higher, there was a day in which Bitcoin traded $1 billion, which is like super low. We were like 5% away from scoring a low 6-year number in terms of trading activity. So it does feel like the market was in this apathy mood. And then all of a sudden, obviously, there was the Bessent announcement. And I think the market started to pay attention again to this trade. Bitcoin was underowned. And it's good to see, right? I totally see Bitcoin as this aspirational asset that one day will become something more like a safe haven, or the asset that which people run to when they are queasy about the very foundations of our monetary regime. That's not where we are now. Bitcoin is obviously way more of a risk asset, which speaks to how early we are in its development curve. That's fine. But sometimes it's good to see, right? Whenever you see the theme coming back to the fore, at the same time, you see Bitcoin kind of regaining the grasp of the narrative. I think it was very positive. I mean, I follow these liquidity trends very closely. Things shifted dramatically since then. So the volumes are much better. A lot of the relationships that we typically see in the beginning of bull markets are starting to show up. So yeah, overall, I think it was a very, very interesting event.
Yeah, I want to. We're going to double click on this because you follow the volumes very closely on these order books. When we were talking last time, I know I was showing you a bit about how important volumes and flows are on the ETF side, right? Because this is obviously where a lot of allocators are starting to get exposure to Bitcoin. So before we kind of jump over there, Tomas, I know that you are following the fund flows very closely, and you have this kind of proxy rotation measure where you're looking at the DRAM flows and you're comparing it to the crypto flows. How has that looked in these last few trading sessions since the debasement trade has kind of sparked back in investor minds?
Yeah, and I guess for context here, there's been a lot of people that have talked about this AI rotation trade, and unfortunately, we don't work at a firm where we can easily see at a aggregate level, are people selling crypto exposure like a Bitcoin ETF, for example, to buy exposure in other assets like semiconductors. It's kind of a feel anecdotally. And but one proxy that I've been using is an ETF called the DRAM ETF, which was launched in early April of this year. So it's a very young ETF. But it actually, in the run-up on semiconductors in April and May, it's actually outpacing Bitcoin ETF flows if you had indexed them together as if they had started at the same time. So Bitcoin ETFs, which had set all these kinds of records in terms of net inflows and growth in AUM, DRAM has doubled it basically on the same pace. And so it's been a very impressive growth story there. And what's very interesting, this is something I shared yesterday, is that much of the record outflows we saw in ETFs during the second half of May into June and early July was a time where you saw an acceleration of inflows into DRAM, where they had very few, if any, outflow days. And what's been fascinating to see is that in the last week, since the U.S. Treasury announcement, and as the price has been bidding up, every single day we've seen net inflows into Bitcoin ETFs, aka they're buying Bitcoins, whereas DRAM has actually seen a series of net outflow days. And I don't think that I've seen this many successive outflow days and this kind of strength of outflows in the DRAM ETFs for the data that I've been tracking. So again, it's anecdotal with some level of science behind it, but I do think that this is actually one of the first signals that I've seen of a potential re-rotation from AI back into crypto.
Yeah, that brings me to my next point. If we look at IBIT and the volume on IBIT, it was trading, well over let's say like 100,000 shares. I'm sorry, not 100,000 shares, over 100 million shares, according to my screen here, for the 3 days subsequent after the announcement on. So we're talking about August 19th, 20th, and 21st. That is astonishing volume, and we've seen how that's translated in the fund inflows. I think total Bitcoin fund flows since the start has totaled around 2.5 billion. The way that markets typically react to catalysts and the way price tends to clear mechanically are very important, because you want to see price react in a very aggressive, non-discriminatory fashion, is what I would say, with high volume, high flows. These are the types of moves that are more durable. If we compare that to how the market's traded back from the kind of like the February lows through the May run up, when we got up to in the 80s again earlier this year, that was more of like a stair climb. It wasn't really like an elevator. If you look at the price of Bitcoin right now, trading north of 80,000, the candles look just like they're straight up right now. So this is much more constructive if you're looking at from an order flow price action standpoint. And David, when we talked earlier this week, we were kind of trying to see, who are the types of players that are reacting this quickly. Is it advisors, or is it something? It has to be maybe somebody faster, right? So like that, like smart money hedge funds, quicker institutional participation versus perhaps your Raymond James, Edward Jones type advisor who's now starting to pay attention to Bitcoin on a sudden news of Treasury buybacks.
Yeah, great question. I think it's hard to know, but if I had to guess, I'm with you, Gabe. I think this was probably kind of fast money moving. For example, one corner of the market where we started to see a lot more action than before is in the CME. The CME basis for me is a very good measure of demand for leverage, but also activity of a very specific institutional corner of the market. And the CME basis has been very depressing to watch for probably about a year now.
It's like paint dry, right? It's been pretty boring.
Yeah, exactly. It's been, I would say, the way I look at it, and I know folks look at different ways. I look at on a 30-day constant maturity basis. And I would say, let's say a healthy level here would be probably between 8 to 12%. That is probably the level that would allow those big delta neutral shops to start running their basis trades and start bringing demand to the spot side again. And we were well below that. Actually, as I was just saying about volumes, the CME basis as per this measure was hitting multi-year lows. I think at the lowest point, we were probably at something like 4%. Which is well below what a delta neutral investor would need to get a return on basis trading, and now we're kind of back. We're slowly creeping back. We're not where we were before, so probably now the 30-day constant maturity annualized CME basis is ranging between 6 to 7%. So that's obviously far from where we have been in previous bull markets, but it's definitely a big recovery from what I've seen in the past. And I'm just mentioning this as an example of like fast money, right? These are folks that are monitoring the market all the time, and they can get back very quickly whenever the conditions are present. And I'm sure there's a lot of other investor pockets, probably more momentum-driven hedge funds, even I would say some crypto funds that were probably sitting too much on cash and started to feel bolder and more willing to allocate. So that's my guess. I would say I think that's a normal development whenever there is a market regime shift. You start to see the fast money coming first, but then eventually you want to see the mainstream broader market coming back. And this is why I like to look at indicators like the Coinbase premium, for example, or just how much Coinbase is participating in terms of I look at CVD, like net taker flow. And this has been interesting too. The signal here is a little bit more erratic. But one thing I can say for sure is that the Coinbase premium, again, the way I look at it, kind of on a Z-score basis, it was very negative for a very long time. I honestly don't think the Coinbase premium has been this negative for this long in many years for Bitcoin. And we're definitely starting to see a reversal here. It's still erratic, still whenever Bitcoin stalls, right? As we're seeing now in the high 70K, low 80K level, this thing is still kind of a little bit moving sides, but it's definitely a difference from where we were before.
Yeah, these are the indicators that I think we also tend to follow very closely here at CF Benchmarks. I want to pass it over to Cristian, who's on our product team and follows these indicators much closely. Cristian, what are you seeing on your desk, from CME, from other things that you look at, and give us a rundown, maybe perhaps even on what basis trading is for the audience.
Yeah, it's funny that you ask, because I actually wanted to go through the mechanics of basis trading and who is taking the opposite position when a long trader opens a leverage position in the futures market. So I think it's very important, right? Is it matching directly another trader that is taking a directional bet on the downside? Is it a basis trader that is taking that opposite position, or is it a market maker? And so, yeah, maybe just taking a step back and following up very quickly on David's point. As you mentioned, we have a few indicators that we monitor here at CFB on a daily and even on a second basis many times. So we have a basis index and we have a basis screener that shows you basically the sort of the healthiness across the different expirations. But in my view, the recent spike in the Bitcoin future basis is a clear symptom of capital scrambling for basically leveraged exposure to hard assets as fiat currencies devalue. So this brings us back to the debasement narrative. And so when global money printing accelerates, traders don't just want to own Bitcoin. Some of them want to maximize their upside. And I think it's very important to understand the mechanics that these markets can have on the underlying spot market and its broader ramifications. So maybe just to take as an example of whenever a trader opens a long position and the opposing counterparty is a money market maker, I'd like to just quickly give a rundown of what that means for the underlying spot market and how we can put an outsized pressure on the sort of the upside potential of the underlying market, in this case Bitcoin. And so this is sort of because futures, just coming back really quick to the ramifications in terms of debasement. This is sort of because futures allow traders to put just down 20-25% margin on collateral, and as such, these aggressive speculators are effectively piling into long contracts to outrun currency depreciation. And so, to hedge this, when you have the market maker taking the opposite position, are forced to buy the equivalent amount of basically the equivalent amount in the spot market or ETF markets to stay delta neutral. And sort of this creates a direct feedback loop where speculative leverage on the future side actively forces massive physical buying pressure on the cash market. And so this dynamic essentially creates a double-sided engine for the rally. So while aggressive speculators drive up the basis to front run the debasement, if you will, you have institutional allocators drawn to trade from the opposite side. So buying spot Bitcoin to capture that sort of fat basis yield as an alternative to holding cash that is losing purchasing power. I mean, as you mentioned, dollar is down 2% this month. So what a better alternative than this? And so ultimately, this structural transmission sort of connects high conviction leverage with risk-averse institutional flows and turns what is a macro panic out into an upwards spiraling liquidity vortex for Bitcoin. And maybe just very, very quick on what we're observing also on the volatility surface of Bitcoin. We are seeing namely an aggressive forward call skew, which is a textbook reflection of a macro regime driven again by systematic global currency debasement in this case, right? In the particular case of Bitcoin. And so again, when central banks expand the monetary supply and sovereign debt spirals, capital aggressively seeks refuge in hard assets, basically. So therefore, treating Bitcoin as the ultimate liquidity sponge. So the sharp spike in short-dated out-of-money call implied a volatility that we are currently observing, towering over its put counterparts near the 40-day expiration horizon, signals effectively an intense, well, not an intense, but somewhat of a panic among traders. So instead of buying protection against a market crash, participants seem to be sort of scrambling for leveraged upside exposure to Bitcoin, anticipating this re-rating of fiat currencies.
Yeah, since the spot ETFs launched in early 2024, we've observed this bullish sentiment in implied volatility surfaces on some metrics with the CME options that we looked at. There was a structural shift that happened really once the SEC approved covered call writing on the ETF. So first it was IBIT, and that has inherently kind of dampened implied volatility from a mechanical perspective, because you've had this kind of harvesting, this implicit kind of just automated harvesting on selling calls on covered spot positions. What we're witnessing now, in summary for the audience, is a very constructive sign. It's something that we have not seen really, I think, materially since the SEC kind of approved covered call writing. So it's kind of a big deal to have this regime flip on the skew. And at CF Benchmarks, we do like to look at a lot of other indicators to define regimes. One of the models that we've built on the research side is something that we call a market cycle engine, which looks at things like breadth, price trend, momentum, leadership participation, fund flows. What's the sentiment in the derivatives market? Mark, what are we seeing right now in our market cycle engine?
Yeah. When we look through our market cycle engine and some of the indicators we track, we're seeing a lot of things that we really haven't seen since Q4 of 2024. So if we'll start off at the top with market breadth. If we look at the percentage of tokens above their 50-day or 100-day moving average, we're seeing anywhere from 70 to 90% participation above those moving averages, depending on where you're looking. So 50-day, about 90% of tokens in our universe. Longer dated breadth, the 200-day moving average, which is one we kind of like to look for if we want to see a long, broad, sustainable rally. We're sitting at about 50% of tokens above their 200-day moving average. And we haven't seen that since Q4 of 2024, really. So what we'd want to see to continue from a breadth standpoint is we'd like to see the tokens come up a higher percentage, maybe 60 or 70 above their 200-day moving average. That's when you really get into a confirmed kind of long-term risk on, and something I'd look for to see if that was in fact the bottom that we hit. Another thing that we look at are some of indicators of short-term momentum. So we'll look at moving averages and our broad cap index relative to those moving average. So if we take a medium-term moving average like the 100-day, we're sitting about 20% above the broad cap's 100-day moving average. The last time we were 20% over the broad cap's 100-day moving average was actually July of 2025. We didn't even extend that much from the moving average in October when the market actually topped. So we're starting to see some of these levels of extension above the moving averages that we really haven't since early 2025 or late 2024. Other things we're seeing is the CME basis expansion on Bitcoin, ETH, Solana. Those are at levels that it really hasn't hit since kind of early to mid 2025. It's hit there a couple times. We've actually seen the basis on Solana was actually negative for probably about 3 months out of the year. That's positive for the first time since probably is consistently positive for the first time since February or so of this year if we're looking at the front month contract. Another thing that we look at is also the options positioning. So we'll look at that call skew as a positive sign. Some indicators that I also like to look at are the difference between implied and realized volatility in the options market. In market stress events to either the upside or the downside, we'll typically see realized vol actually pick up and cross over implied. Normally there is a premium for implied volatility. The last time we really saw that flip in volatility was in February of this year. So we actually did not see implied go above realized in the drawdown in June. So it wasn't too extreme of a stress event there using that metric. So those are kind of, and then what our indicators are ultimately pointing to is we are in, for the most part, the early expansion phases of a market cycle.
Yeah. So if you think about this as like a checklist, we're seeing, according to our study, things dramatically shift right now, and we've come from this bearish regime into potentially a new expansionary cycle. And if you've got your price charts in front of you, right now, if you're listening to this, just look at the differences between the price action on Bitcoin. When you look at the sell-off that happened in January, from the swing low to when you get that swing high in May, where we run from 57,000 to the low 80s. Just compare the two speeds, right? This is a very different market. This is the type of market that when you get this kind of speed, when you get this kind of aggressive bidding behavior, and markets are basically saying, we want Bitcoin. I don't care what the price is, just give me more Bitcoin. This is what shows up in the derivatives markets. You see the skew on the option side. You see the basis expansion. We did not see that before, and it was telling us. I mean, we probably didn't want to say because we're just really hopeful that this was going to end. Back in May, that this was going to be a continuation, but we weren't seeing any signs of like this durableness in that type of upswing. And we're starting to see that now, right? So. Overall, I think in summary, it's just like, let's, for the people that are listening and wanting to do their own research, like these are the things that you should be probably taking notes on. This is what you need to be writing down, because these are the things that confirm, whether this is going to be something more durable or not. And we've seen that shakeout before. And so, just stay tuned with that.
Well, if I can add on the durability, like the things, comparing to May, here are kind of like the high level things that I care about. Situation with Iran with respect to oil prices and acceleration of oil prices. May was arguably a lot worse, more uncertainty built into it than where we are today. Situation with the monetary policy side. Yes, there's uncertainty there, but what the signal from the Treasury was very clear that policymakers are going to be vocal about yields at these levels, whereas back then we didn't have that kind of clarity. Additionally, when it comes to timing, back in May, the narrative around the 4-year cycle, having to wait another potential 5-6 months for people who were sidelined to start getting interested in again. And we're now in August, 2 to 3 months away, and people are looking at the chart saying, hey, maybe it was a mistake to be 0% allocated. I should start coming into the market. And then, of course, Clarity Act, this one's been a headache, but we're getting ever so closer to the make or break day so that we get some level of certainty on the outcome. And so, I think there still exists a lot of uncertainty in the market, and the risk reward still exists both directions. but there is, I think, some semblance of greater certainty around some of the bigger risk factors that structurally were putting Bitcoin down. And one thing that I keep reminding people is that it's a very reflexive asset. No one's talking about Michael Saylor going bankrupt anymore. So as price moves higher, good things happen. Good things happen brings higher prices. It's a very tricky concept that I think people fail to grasp.
Yeah, that's a good point. I kind of want to broaden this out a little bit past Bitcoin. If this is, we were just talking about the debasement trade and debasement dynamics, but as we've seen in the alt space, you're getting a lot of DeFi participation. You're seeing Uniswap rallying hard. Aave's been on an absolute tear. I've been following that one. Is there something more going on in crypto beyond debasement? And I want to get Pascal and David's take on this first, because it seems to me that we shouldn't be seeing this broadening of participation quite yet, right?
It's a great point, and if you don't mind, Pascal could go first. I'll just have to drop in a couple minutes.
Sure.
I think it's a great point, Gabe, and it speaks to a few things. Number one, of course, there was a big trigger, a big driver, which was on the very day that Scott Bessent made the announcement that triggered the Bitcoin price. Just a few hours later, there was this big meeting with a bunch of industry executives at the White House, and President Trump announced that they are figuring out a way to onshore hyperliquid to the US. This was obviously a major driver initially for hyperliquid, but it quickly started to spread out across the DeFi ecosystem. The thing that I believe is interesting and potentially different from the past cycles is that right now, I think in crypto, we have these very solid verticals beyond Bitcoin that have a very clear product market fit. A lot of them are already attaining very decent size, right? You can think about stable coins. You can think about tokenization that is about to come. You can think about a protocol like Hyperliquid that is generating many hundreds of millions of dollars of revenue on an annualized basis, in a lot of these DeFi protocols. So I think, and this is especially still circumscribed to the more like crypto native community, but there's definitely this very strong excitement around these projects that have figured out their tokenomics, that can generate revenue, that have been showing growth, that have been showing product market fit, and have something truly innovative to add to our financial infrastructure. I don't think this is a narrative that has caught on fully in mainstream circles. One way to see that is just compare the ETF flows that we saw on BTC, which were massive, on ETH, which were pretty strong, on Solana, which were decent. If you look at Hyperliquid flow, ETF flows, they were actually very, very low. And that speaks to me and shows me that I think the mainstream public is still not as aware of this whole revenue generating crypto complex that all the crypto native folks are very excited about and have been excited about for a long time. And this is another very, very exciting part of the market. I think it's going to come up if we get to this new bull market cycle. You're going to have Bitcoin, which is already established as this big global macro asset, but you also have this complex. And I think now it's their time to shine.
Pascal, that was great, David. Pascal, what do you think? What's your take on this broader participation? And yeah, I guess there's a divergence between price and fund flows here with some of those alts. I think you might still be on mute.
Sorry, there's a touch button as well on my mic. That's why. Yeah, so we're still like wondering the same at our bank, where we're like, okay, traditionally speaking, when it came to kind of like bear market up rallies or like going out of the bear market, I mean, into a potential new bull market, it was usually Bitcoin taking the charge, leading the charge, you know, like Bitcoin dominance, you know, which to my eyes was kind of like ticking down a couple of weeks ago, but then just now maybe kind of has upticked again, which shows to me, okay, this might also be kind of sustainable, this rally. But then, yeah, we were wondering, okay, why would it be different this time around? And why, as you just said, you know, why have some of these altcoins reacted so heavily? I feel like you can look at it from different angles. If you look at the charts, 1-year charts, I mean, a lot of these alts are still heavily beaten down, you know, and so maybe we can argue it's just some sort of catch-up trade of this kind of, you know, getting some breath and potentially coming to life here again, at least wanting to show, hey, we're not dead yet. So that's certainly one of the perspectives that you can have, but then maybe a little bit more fundamentally, and that's what I'm trying to wrap my head around. Is this also kind of front running and showing us that, you know, the Clarity Act that was already brought up, is that sort of way mispriced, you know, in terms of like, if we look at Polymarket, the odds, I think we're now below 15% or something for the Clarity Act actually getting passed this year. And so, yeah, maybe this is kind of smart money positioning there as well, because they know if Trump wants his way, he will get it. And as David already mentioned, you know, he talked about hyperliquid and stuff. And so this is really what I'm asking myself, because if you zoom into the like deeper degen crypto ecosystem, I feel like there is this sort of renaissance going on, you know, talking to other people who are deep in the trenches, where they point to these, as David said as well, these protocols who are very solid, you know, they're now finally generating revenue, some of them doing crazy numbers, you know, like you all heard of Pump, I guess. I just recently had the founder or one of the founders of Pump does fun on my show, and like the numbers he was presenting, it was just mind-boggling, you know, what they're doing. And so I feel like around a lot of these alts, especially these newer alts, you know, people are now kind of like, okay, you know, we have something to show. They're solid. It's almost as if this buyback thing has become like buyback as a business model, you know, which like crypto is now clinging to, and hopefully it is coming to fruition, and something like a Clarity Act could further on the regulatory side help get more clarity regarding this. And even though to my mind it's also debatable if something like a buyback as a business model, is that even a good thing, you know, with a protocol in the beginning? Should they be buying back like half of their float or whatever? And so, I mean, that's really what I feel like is shown in these prices that we've seen in the last couple of days, that there might be this renaissance going on that could further be accelerated through something like a Clarity Act, and all of a sudden crypto would be deemed, okay, it's now TradFi acceptable in that sense, because you also have a way to measure these things, and it's not just air anymore.
So yeah, we are kind of approaching time rather quickly, and I do want to talk about the Jackson Hole Symposium, and maybe this could just kind of serve as like our week ahead segment, because basically this is going to be you know, the focus here in the next few days. The symposium kicks off right now today. We're going to get the agenda tonight, I believe, but the real thing is it's about financial innovation and payments, and that's kind of the core central theme. So when you talked a little bit about, you know, how the markets may be mispricing the Clarity Act, not assigning the correct value, I think for me, one of the things that perhaps the markets and investors might not be fully appreciating is just the fact that we have the Federal Reserve really focused on payments technology. And I'll read something from the Kansas City Fed's own scoping text for the symposium, which they released on August 25th, where they said payment systems are the circulatory system for the economy and interact with monetary policy in myriad ways. Innovations include new digital payments, instant payments, cryptocurrencies, and stablecoins. So that's very clear that the blockchain infrastructure, the technology is front and center here as we enter in this Jackson Hole Symposium. Last year we had, I think, we had a little bit of like an easing bias type
symposium two years ago, or maybe it was in 2023. We of course had a very hawkish Jackson Hole symposium with the discussions that followed from then Jerome Powell. What I want to ask, and maybe we could do just kind of a round table, is what are we all expecting potentially from this meeting, and then we can kind of close it out.
I guess I'll go first. The first thing I'm going to say is I expect absolutely nothing on when it comes to any type of yield curve control or balance sheet. I don't think we're going to see any type of forward guidance there. I think that Warsh will probably do his best to steer away from any questions around the Treasury's buyback for now, while he waits for the task force. Yeah, I'd like to see kind of some of the results of those task force or what we're expecting when the data comes in as well. But I am pretty optimistic on the whole crypto and payments and blockchains things. I would specifically be on the lookout for any type of not guidance or regulatory clarity or indications towards clarity that could benefit a lot of these crypto linked companies, as well as non-crypto linked legacy payment companies. So I would look to names like Visa, MasterCard, Square, Stripe. All those names are kind of, you'll probably see some elevated volatility and increased volume around Jackson Hole. I was actually looking at Xstock's trading volumes, and I saw that the ones with the highest DEX volumes were names like Circle actually coming into this.
All right, who wants to go next?
I'll just hop on really quickly and just say that I also expect that there'll be some level of disappointment around what Warsh will say in response to questions or during his speech about the U.S. Treasury action or any hints on monetary policy. So I tend to agree there. I'm actually more curious to see if the market reacts perhaps disproportionately, where they have some level of expectation built in that he'll do something or say something, and he'll just disappoint. So I'm more reacting than expecting some like fundamental drift on some really interesting news coming out.
That makes sense, Pascal. I know from across the pond. Wanted to get your perspective as well.
Yeah, obviously, from across the pond, it's sometimes hard to follow these events, but I mean, we do as well. And I mean, I'm probably second what the other people already said, Mark and Thomas. I think, in terms of if we go by how Warsh has behaved so far, with the other meetings that he had, the chances where he could have said something, he didn't, or he explicitly didn't want to. And so I think, why would he change it now? I guess there will probably be a lot of questions on what does he think about the Treasury buybacks? Will the Federal Reserve sort of be supportive of this or whatever? And I think, as you guys already said, there won't be that much information coming out. So I also have rather low expectations, but just curious to see how the market will react and how Bitcoin kind of reacts, because so far, again, I sort of had the hunch that it might be, we had this big pump with the green candle, and then maybe things are calming down a little. But so far, it's been looking still kind of constructive with Bitcoin. And so we'll see where this will be going, and if Jackson Hole has any sort of treat that can move it in either direction.
Yeah, no, thank you for that. I also don't expect very much forward guidance from Mr. Warsh, and I am expecting some bullish tailwinds for some talk about the innovative side on blockchains, on innovation. I tweeted something out earlier today when we did our X Stocks weekly market research, where we talked about all the different working groups that are going on at the Fed, and Mark Andreessen, of course, is on one of the working groups with AI and jobs. And one of those what that kind of inherently ties itself to is kind of like these innovative technologies that AI will use. And I believe that Mark Andreessen from A16Z is someone who understands blockchain technology, is someone who's going to, I think, bring that type of ecosystem to be front and center as the Fed is a central bank that's focused on payments, on the currency. So I'm excited for that, and really from the Fed, it's, since you're not going to get too much from the forward guidance in the traditional sense that you got from Powell, from Warsh, you should really just try to find what their view is on the economy overall, the state of the economy. That's probably what's going to help you so much in trying to determine, okay, what could like a potential implicit reaction function could look like. It's not so much like they're going to be going out there and explicitly saying, this is our reaction function anymore. So you just really need to try and see, if there's any questions that he gets or any comments that he could make about the economy tomorrow morning. That's something that I would keep an eye on. I do want to maybe close out with one final topic because we all know it's earnings season. We all know who are the big juggernauts. NVIDIA delivered a pretty blowout quarter, revenue surging 106% year over year to $96.2 billion. I'm looking at NVIDIA right now. It's trading up about 8% on the open right now. Cristian, I'm not sure if you could just break down really quickly before we close out. We should just talk a little bit about like the NVIDIA earnings recap for the audience, and give us your take on how they did, and also perhaps where we should look at for compute metrics going forward. What are some of the things that we could follow?
Yeah, absolutely. So just very quick on NVIDIA. I mean, I don't know. I don't think anybody knows where we are on the AI curve. Are we on the hype stage? Where are we? But definitely anyone waiting for the AI hype bubble to burst just got hit with a bit of a reality check. Remains to be seen what happens in the future. But yeah, in short, as you said, it kind of crushed it again, pulled in $96 billion in a single quarter, I believe, and so very well done once again. That being said, this kind of gives me a good segue for our latest developments at CFB, because as you know, we always try to stay on top of what's important. And so to be precise, we have just a few days ago officially launched our new GPU rental index, which means that we are bringing our institutional grade benchmarking expertise to the AI infrastructure space. And so drawing straight from our product guidelines, this index tracks and basically tracks the hourly on-demand rental cost of and here it's going to get a bit technical, but it tracks the on-demand rental cost of a single NVIDIA H100 SXM GPU, which again is expressed in US dollars per GPU per hour. And so to achieve this, we aggregate real-time pricing data from a set of vetted panels of approved cloud providers and also marketplaces. And so use cases, you can think, launching a futures market on this for hedging purposes, or on the other hand, give businesses a clean pricing to budget their training expenses. Now, as you know, there's been a lot of talk as well on the CME launching a futures in this, on ICE launching a futures in this, and there's a couple of index providers out there that have been also producing an index in this space. And so I just wanted to take a moment to talk a bit what truly sets us apart in this case, and that is that we are an independent index provider with a close to 10-year track record. So I think that's very important to keep in mind. A lot of this, alternative GPU indices out there are published by firms whose main business is being a GPU marketplace, for example, meaning that their index is to some extent a byproduct of their core business, right? As opposed to here at CF Benchmarks, where our core and sole business is benchmarking, is index provision, right? And so, because some of these indices, actually the most prominent ones, they rely on private and opaque data and also private methodologies. You cannot really, you don't really know what is the exact methodology that they're following. And even if you knew, you don't know what the what data they're using, because that's private as well. So that's kind of in direct conflict with the fundamental rules of what makes a good index. If your data isn't public, nobody can replicate your numbers to verify. They match actual economic reality, which is one of the key principles of a good index. And it's very hard to prove that the index is safe from whatever kind of manipulation, which is another key principle of a good index. And so over the last 10 years of building benchmarks here at CFB, we've learned through, admittedly, some very hard, lessons, exactly how to spot and manage these kind of structural risks and how to manage these types of indices. And so, by using, in a nutshell, fully public data and an open methodology here at CF Benchmarks, we've built a robust standard, effectively, that anyone can openly stress test and actually trust. So you can think of it as open source technology or software that anybody can poke holes at, and to ensure that it's, it doesn't have any sort of vulnerabilities.
Oh, great. No, thank you for that. That's exciting stuff. Yeah. So for those of you in the audience, you will be able to follow this index on our website, right, Cristian?
That's correct. On our website, you can see the
Yeah,
charts and the methodology and whatever is needed.
So when you think about the economic reality of an H100 GPU, we're trying to basically define that market and allow the audience here to follow along. When you look at these stellar numbers that are coming out from NVIDIA, there's all these hopes and dreams types growth metrics that they've been delivering on. When we're talking about triple-digit year-over-year growth, they continue to deliver. Obviously, the price of compute is going to be an important variable for their continued success. And so I encourage everyone to go to the website, go check out the new H100 GPU index that we have. And with that, I want to say thank you to Pascal for joining us this hour. It was a real pleasure having you on. It was super timely given everything that's going on with Debasement and your background with your book. So please, everyone, go check out his blog, his Substack, check out his book as well. Scott, we hope to have you back on as well in the future. There's going to be a lot of things happening, I'm sure, in the near term. But it was a real pleasure.
Yeah, great. Thanks a lot, Gabe, for getting me on. It was amazing. Yeah, and hopefully I'll be back in the future again.
Of course. And to the audience, thank you again for joining us for another CFB Talks Digital Assets Live. As always, it's a real pleasure to spend an hour with you guys talking markets. Always do your own research and always trade safe. Until next time, we'll see you all next week. Thank you.